there are some question marks about what could happen in the real estate sector as more and more people potentially might not be able to pay back rent. We've heard that from a few tenants, as well as Cheesecake Factory, one of the ones that's impacting the mall stocks right now. We saw that last week. But alongside the front of that happening in the real estate space, there's also a lot of questions being asked about what the Fed's new actions might be doing to the mortgage market as we look at the way that it's been impacting mortgage lenders. Interestingly, Congress did not include relief for the mortgage industry, even as lawmakers required mortgage companies to allow homeowners up to a year's worth of time to delay making payments on federally backed loans. And the way that the Fed has been interacting with the mortgage-backed security market right now is potentially leading to some blowback. I want to get to Brian Cheung to discuss what he's seeing on that front. Brian?
Well, the mortgage market is a little bit of a head scratcher for most people, but all you need to know is that oftentimes mortgage bankers have a hedge against any sort of situation where the mortgage market rates are actually above where the consumers lock them in at. And what's happened is that because the Federal Reserve has slashed to zero and bought massive amounts of agency mortgage-backed securities in the market, the rate is now far below where it was, which means that a lot of those hedges were blown up and a lot of these broker dealers are now being left holding the bag. So there's a lot of concern that in the mortgage market, the mortgage-backed market per se, it's not necessarily the underlying mortgages themselves, it's in the financial plumbing of those types of mortgage products. There's concern that actually liquidity is drying up, which is very emblematic of what we heard about in the US Treasury market, in the money markets, in the US dollar markets, many other corners, which is why the Federal Reserve has been trying to calibrate the amount of agency mortgage-backed securities that it's buying under its quantitative easing program. So the Federal Reserve has kind of been levering with the amount that they're buying. You have to keep in mind that this is different than 2008 because the Federal Reserve has actually had an open-ended quantitative easing program as of last Monday. They aren't committed to a certain number. They can either over-lever or under-lever the amount of purchases that they made. But again, the Mortgage Bankers Association, which is a trade group, has said the Fed actually came in and maybe bought too many mortgage-backed securities last week, which is why the Fed might be trying to pare that back this week. We'll be paying attention to the New York Fed operations, which actually do the direct buying themselves as we get those daily operations this week. But again, the concern underlying all of this is that the mortgage-backed securities market may be showing signs of stress again.
Yeah, I mean, we're talking about just the swings on the 10-year. That's what we've really been watching here, since that's what's tied to most mortgage rates in terms of what you initially get when you ask a bank for that. But I mean, when we looked at it, the Fed stepping in here, ironically, that's the Mortgage Bankers Association was asking for that help, but just the swings that we've seen, it's made it tough on that. And then also to the other point that you raised when we think about 2008 and whether or not they can withstand people not paying mortgages here, you're talking about a few borrowers in the short term, but the idea that it would extend to about 25 to 50% on some estimates we're getting of borrowers being unable to pay, the longer and longer this goes, that risk obviously grows. So what are you looking at in terms of stresses there?
Yeah, and this is absolutely the underlying point, is that everything I said is probably unintelligible to most people. But what we do know is that the Main Street effect of this has to ripple up to the mortgage market at some point, right? For right now, there's a lot of concern that with effectively all of these workers rushing to unemployment insurance, that the next domino to fall is going to be an inability to pay rent, an inability to pay on your mortgage. And when we talk about housing costs in the United States, we have to remember that the capital appreciation of a lot of homes has really gone up post-crisis. And because of that, it means that those mortgage payments might be larger. And if you have no income, it's going to be really difficult to pay those off. Now, I want to emphasize, though, that this is not the same kind of stress that we saw in 2008, where the blowing up of the mortgage market was in and of itself the crisis. This is kind of a reverse engineered version of that, where the coronavirus led to a number of other domino effects that could lead to stresses in being able to pay back those mortgages. Now, again, we're not there yet, but it's definitely a concern that those inside the industry are saying, as if this loss lasts longer than we think, that could be the next domino to fall. So all eyes are really on that key mortgage market. But as I've just mentioned, it seems like the backstop for that, which is the mortgage-backed securities market, is already seeing signs of stress because the confidence in that market is already kind of flooding out as a result of the concerns that I just laid out.
Yeah, and we'll continue to watch the moves on the 10-year right now, seeing it back down the yield 0.62, which of course is a lot lower than what we saw. I remember it was just up around 1 not too long ago when we were dealing with all this as well. But Brian Cheung, thank you for bringing us that.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.